Happy weekend, everyone. I hope you're all doing amazingly well and relaxing after a fruitful trading week. John Henry here, SSFTG. Welcome to This Week in Review in the U.S. markets. In this, we take some time out to look at the technical overview of the markets and what to expect as we move into the next week. If this is your first time on the channel, welcome, my friend. I hope to earn your like and subscription today. First off, let's take a look at the news ahead. I wanted to break it down a little bit easier so it was easier to see than the last few times. So instead, I just got a nice little screenshot here. First off, Monday is going to be the last day of February. That's going to be February 28th. And as we can see, there's not really much news at all going on. It's just a bunch of medium and small news announcements. 8:30, 9:45 does have the U.S. Chicago PMI, which can definitely move things around, especially if there's nothing else going on. But, I mean, really, we know, and I'm not going to talk about it too much because this is more about the technical stuff, but there's a ton of things going on in the global side of things with, you know, war and Russia and Ukraine, and without going into that whole thing and stepping on a political landmine, we are in a really not so healthy situation. There's a lot of fear in the markets. There's a lot going on outside of just the news this week. So I feel like it has to be prefaced, and I'm sure you've seen 100 emails already from your brokers. Be careful. These are the kinds of markets that will rip your face off, put it back on, rip it off again, smile at you, put it back on, and pull it back off again. And it's going to, I mean, do not play with these kinds of markets. You've got to be very careful. Keep your risk in check. Over on to March 1st, we do have our first large news announcement for the week. First off, though, at 9:45, we have the market manufacturing PMI and 8:55 Red Book and all that stuff. But 10 o'clock is the U.S. ISM manufacturing PMI. The forecast is 58. The previous was 57.6. And, of course, it will be Tuesday then on the 1st. So we will also have the API report. There again, I mean, crude oil, you want to talk about a market that's smack in the middle of the line of fire, so to speak. There's a lot going on with the oil side of things right now, and obviously the API reports and the inventories and all of that might not necessarily have as big of an impact compared to what's going on globally. On March 2, we have a couple batches of news announcements coming out. 8:15 has the U.S. ADP employment change, and then the big announcement at 10 o'clock, Fed Powell testifying. And then Wednesday is inventory day, so 10:30 U.S. EIA crude oil inventories. We'll have to kind of see what the API report comes out as to give us an idea as to what to expect for the 10:30 inventories on Wednesday. Aside from that, there's not really a whole lot else going on, although they do have the 1400 Fed Beige book, which usually doesn't do anything, but, you know, hey, you got to be careful. We know what's on the calendar just to be safe. March 3rd brings us a ridiculous amount of news. There is a huge amount of news going on the 3rd. First off, at 8:30, we have the U.S. initial jobless claims forecast 225,000. We'll have to see how that comes out as, because that can definitely move things around quite a bit before the market goes off. But at 10 o'clock, we have the U.S. factory orders month over month and Fed Powell testifying again. And to add to that, the U.S. ISM non-manufacturing PMI. So there is a huge amount of news coming out on the 3rd, and will definitely be moving the markets around probably quite a bit. And what's a Friday without going into March 4 non-farm payrolls? Hey, why not, right? Let's get the ball still rolling down the hill at max speed and get that volatility cranked. 8:30 on March 4, of course, U.S. non-farm payrolls. We've got to be very, very careful around those numbers. We also have the unemployment rate, forecast 3.9%. The previous was 4%. And the U.S. average earnings year over year, 5.8%. The previous was 5.7%. Lots and lots of stuff coming out on Friday, so be very careful on top of all of the other days and everything else going on. Friday's going to be a pretty big one with NFP. Now remember, if you aren't sure what's going on or how we're finding all of these major turning points in the market, check out the Day Trading Academy. It's loaded with almost 20 hours of video course material, so you know exactly how to approach the markets and why they're doing what they're doing. We also build a game plan every single morning with YouTube members at 9 a.m. ahead of the New York Stock Exchange Open, so click the join button below for more info on that. All right, so let's jump over into some charts. First off, on the Nasdaq, we can see that, we didn't get any retrace. There was nothing to sell. The market never came back and just completely collapsed through the floor. They dropped all the way down to 13,025.75 on the low. Crazy drive lower. But unfortunately, as far as like the swing conditions and everything that we were looking for from the last week, nothing triggered. It didn't get far enough up. Zooming out a little bit to a larger time frame like a daily, this kind of begs the question with this large of a pullback as to, is this our famous double down pullback that the market loves to do over and over again on one of those deeper dives? You've got these standard measured move pullbacks which happen all over the place, constantly, over and over and over again, but eventually that structure breaks and these patterns grow up and you end up getting one of those things times two and you get this big blow off move. This would also be an L1, L1, L1 into an L2, the same thing that we talk about in the academy. There's a lot of different ways that you can break this down, but one thing is for sure, this seems like buyers were pretty interested on this larger dip down here. Now I know we don't normally look at the daily chart, but we've got to be kind of cognizant of what's going on here. This is a very, very big tipping point. One of two things is going to happen with this kind of dive. We either get back above that inside swing and we continue along our merry way back up to the highs, or we understand that there is a brick ton of resistance up at the highs. I mean, look at that structural resistance, is crazy. And now we have a lower high and another lower high with war and everything else going on. I've got my concerns that this might end up growing up to even double this if they're not careful. All right, and here we go. We've got it updated for the week ahead. Now, as far as the overall context is concerned, we've got a huge amount of bearishness coming into the market. Obviously, right? POC stacked way up at the top. If the bulls were buying in for that long continuation and a break for 17,000, ooh boy, that didn't work out so well. That chunked $4,000 off of the top all the way down to that 13K low. As far as the responsiveness goes, like we've been talking about, one of two scenarios. We either do get this bullish higher low from the bulls, but that doesn't mean that they're out of the water. That's where we have our first test, right? This is where the sellers prove that they either have enough to continue down or the bulls prove that they have enough to take it back up, likely through 17,000. So this is going to be the first test zone right here, 15,535 to 15,842. I know it's a long ways away from where we are now, but these 1,000-point days should make pretty quick work of that. As far as the zone of resistance goes, this is a multifaceted area. We've got buyers who got stuck up on the top. They're going to be buying into this dip. We have not seen a POC shift even close. We may see one coming into this week if it stays around here. That said, we still have to assume that those longs are stuck. And if those longs are stuck, they need to try to get out as quickly as they can, and this would be a really good opportunity for them to get out at a small loss to around break even, depending on how they averaged in. For shorts, this is an area of interest because they are finally able to get in on a stop run above the major Elliott wave high. We just had a 5-wave cycle lower. So with that 5-wave cycle lower, you expect to see an ABCD corrective phase back up, and that is the completionary zone right at around 15,500 to push back off from there, and that also lines up beautifully with wave 4's high. If we go even beyond that, this is also the algo pocket for the shorts where 2-to-1s, 3-to-1s have a continuation lower, and it's a stop point above the swing. So it's so many things stacking together for the shorts to try to pressure back here, but until then, there's not really a whole lot of resistance in the way, which means that the bulls may have an easier job of this. We've just got to be careful because if they lose the low, this could get nasty fast. Over on the S&P next, we were looking for a dip, and, we got it. Jeez, oh Pete's. Again, the daily perspective here, when we're zooming way, way out, this is a huge pullback on a much larger scale than just a 60-minute chart. That said, from where we are at the moment, the market did get the dip, and if the buyers were buying into that low, they were obviously wrong, but they were given plenty of opportunities to get out of break even as well before the catastrophic rug pull face plant into the floor. Since then, we've had a very strong V bottom and a reversal back up, so we can kind of update this a little bit from where it was. There we go, and now we've got this updated for the S&P as well. Obviously, the sellers are going to be looking for a very similar situation like we have on the Nasdaq with the trap on the highs and the bullish objective for the longs to get out. And if we look at the order flow, this is where things, they get a little bit different, right? The Nasdaq had its POC way up at the top. The S&P's POC is back in the middle. That's a lot easier for the sellers to pressure back off of, but that's also significantly easier for the bulls to take charge. The buyers on the Nasdaq have to go basically all the way up to the highs to regain control. The S&P just needs to tip the scales at 4,500. That's a lot easier when it's only halfway up. Not to say that the sellers are done, but, if the sellers can't make this work inside of here, then very realistically, the bulls are probably going to be looking for an inside higher low and a rotation back up. The only reason I don't have a bullish zone marked up is because of the fact that we haven't had a break of any of the resistance yet. We haven't had proof that the sellers are losing ground. In fact, everything is saying that the market's going down. We have a bear channel. The moving averages are pointed down. The market is in between the moving average cluster, but we're climbing back up towards the top of the channel. So everything is lining up for resistance. And a POC in the middle at 4506, we can definitely see that the bulls have some room to climb, but they're going to have a fight. Over on the Dow, what a move on the Dow. Wow. So as far as the megaphone is concerned, this thing just absolutely scorched the bottom, dumped all the way down to 32,167, screaming lower. Obviously did not climb up for any kind of resistance up here at the highs and buried through the floor underneath those 33s. If we look in a little bit closer, what's interesting is the bounces off of these were incredible. These were fantastic bounces off of that area. It's once they chopped through and we started noticing that they were just getting out of break even, really. That became kind of the problem. And then we move this over to where we are now to kind of further emphasize some concerns, right? We do know that the Dow in the bigger picture is a dip buyer's market, and this really goes to show that. Holy moly. But as far as, the overall structure is concerned, this definitely needs some updating. And after a little bit of updating, we've got the Dow ready to rock and roll. Nice descending wedge, but with a big caveat here, this descending wedge has a big blow off on the bottom. And whenever we have a blow off on one side, it usually wants to go the other way and kind of overdo that side as well. Equalize, if you will. The move down here usually equalizes up here in terms of distances, and that would place us really, really well into a nice zone of resistance from 35,291 to 35,683. That said, the bulls are looking really good here, but as far as the first level of resistance goes, we do have some resistance at the 34,602s to 872s, and if they're able to make it up through that, same context as the other markets, this is going to be the shot for the bears, and if they can't make it work, this could end up rolling all the way back up to the highs. We don't have a bullish zone marked up yet because we don't have any proof from the bulls yet, but if the bears fail, it's probably not going to take too long for them to get it. Over on gold, where it just never pulled back. It never came back, man. It never came back. We were looking for the dip. Never happened, right? As far as a bullish continuation to the upside, we know that the bears were stuck. They were given multiple opportunities to get out of break even, several, even more inside of there, and then things started sliding away. I was looking for, ahead of the top of the channel, to get a little bit of a dip back to find the bulls before this blow off on the highs. Now that we've already kind of ripped through the top, and not only ripped through the top, but we've made it almost all the way up to 2,000 again, right? Big psychological level. Now, gold is obviously a shelter market. It always has been. When things go weird in the global economy, you know how it is, people tend to look at things like gold as a shelter. It always has been a stable kind of environment. There's a reason that it was the gold standard for a very long time. Maybe we shouldn't have gone away from that. Now, does that mean that the gold bulls are done? No, probably not, but we just need a bit more of a dip. We've completed a lot of objectives up there, but from the bigger perspective, we can see that this has possibly a lot to go. This could very easily be the shallow dip in a significantly larger rally on gold. So with that in mind, then, the first pullback zone from 1843.9 to 34.4 is okay, but I would really love them to dip down to structural support. We get the channel lows, we get all those previous swings. If there are any swing shorts that are still stuck from in there, they'll be able to get out again. That all stacks up back at 1805 to 1783. Now, ahead of 2000, are we going to get that big of a pullback? Maybe, maybe not. We'll have to wait and see. We're at the top of the channel, but again, the bulls really have this thing by the reins. Don't let this top of the channel fool you necessarily. Over on crude, all we wanted here was just a little bit more of a dip before the rip up to $100, and this one also didn't offer up very much of a dip at all before ripping all the way up to $100. Mission complete, right? As far as the continuation up, now that we've hit $100, we've got to reevaluate a little bit. $100 is a monster psychological level, but just because a level is psychological doesn't mean we have to pay too much attention to it until it proves itself. Now, this one has proven itself. Well, I mean, look at the rejection here. We've got to really pay attention to this, so we've got to recalibrate for a slightly zoomed out view. After doing a bit of updating on the chart here and rejecting off of 100, realistically looking at this thing, we've just completed a 5-wave structure to the upside. Not the first time we've talked about this already, huh? Wow, deja vu. As far as the overall movement is concerned, then, expecting an ABCD corrective phase back down to the base of wave 4, that's what you would expect. And, well, 88.82 is a huge amount of support from previous structural resistance turned to support, all the sellers trying to push it down and failing. Well, they obviously exited a break even. If they're given another chance to, we have to assume that they're probably going to show up at least for a bounce. But if the market does want to catch a little bit more momentum down, the big pocket of interest is going to be down here at 77.41 to 74.62. That is a very far ways away from where we are now, I know. But remember, we're talking crude here. This thing can move 10%, 12%, 15%. I mean, this thing can cruise. And, historically, it can go negative. These are things to know. So, as far as this dip, I know it looks far away, but it fits the bill. The zone of support, 77.41 to 74.62, then, is going to be where all of the bulls are going to be waiting for, and that means that the bears in the near term may even have an opportunity to pressure off the top. Fundamental overcast aside, right? We're rejecting off of 100, and if we're going to expect a deeper pullback, this is the spot to do it. Even if this is a bullish market, and we're not going to rotate down to a full-fledged bear dive way the heck down here, and, you know, rotate off of maybe like the 88s or so, still, this is expected to go quite a bit further. That's still another $3 or $4 down from where we are. And then finally, Bitcoin, the one that did actually give us the dip that we were looking for. Finally, geez, at least one of them listened to us. We were looking for a dip to 37 down to 35,800s, and that worked out beautifully. Tons of bounces off of the upper edge in the 37,000s. Those were all the way up to almost $2,000 bounces just off of those, not including the secondary ones all the way down. Now, they did have a dip that went all the way to 34,300s or so, but now that it's back up to 39,000, it's been a pretty nice bounce off that as well. Remember, this is a much larger risk-reward area from a huge picture. If the top is 70,000 and the market's at 35,000, realistically, your risk-reward could be 1-to-1, right? If it goes to 0 and it loses everything, then, well, you're at halfway. You're halfway back. Risk-reward trading mentality there coming out a little bit. But let's get this updated for some of this new info. Now, before we go into all of the technicals and everything, just doing a quick little kind of scrunch, zoom out perspective check on the daily. This is kind of what the market's trying to accomplish at the moment. And remember, this is a huge scale. We're talking with a high of 69,000 and a low of the channel down at like 35. So this is a big, big swing. But as far as the equidistant measured moves that this thing loves to do, these two are almost identical in terms of size. And there is a heck of a lot of support coming in here. So like we've been talking about, although I would love to see a dip down to 25,000, get that Goldman Sachs trap underneath, maybe even retest 20. As long as the bulls are holding these 35s with this kind of strength, that's not going to happen. That said, if the bulls fail and this becomes a problem and all of a sudden the channel's not supporting it, that flush dive from down to 25 to 20 could be a very realistic thing. All right, there we go. So after doing some updating on Bitcoin, really the big thing that we're seeing right now is a wedge. We do know that the bigger perspective bulls are trying to get this thing to creep higher. We've got the major channel low, now a wedge narrowing up. everything is saying that the buyers are trying. But if we look at the chart, everything is also saying that the bears are still in control, and we can't lose sight of that either. As long as the bears are in control, then we have to keep this in context and assume that, well, really, if the bulls are going to take over, they're going to have to break through this resistance first. The sellers have the context, so we've got to put the ball in their court, basically. If the bulls are going to take this, then they've got to break through 43,000, invalidate these sellers, and show that they don't have enough to actually take it back down. Now, if the sellers are able to take it back lower off of that, then buyers are likely going to be on the lower spectrum, 36,120s to 34,400s. That's much more likely because then they're able to reduce the risk down to like 32K. You don't have to risk a whole lot when you're buying way down at the floor, but the probability of success if you're looking for a monster target is also decreased. It's a little bit of a give and a take relationship. As it stands, the bears are still in control, so we've got to give them the edge, but I would love to see the bears get invalidated and get this thing rolling back up. All right, that's going to do it for me. If you're looking for a way to hang out with me and the rest of the VIP crew, you can sign up for a 1-week trial right on the main page of SSFTG, and that way you can hang out with us in the live trade room and see how we operate while the markets are moving. Along with that, when you register, you also get our 24-page guide on risk reward for free, which is an awesome little perk there. I hope you have an amazing week ahead, and of course, stick to those plans. Stay safe out there during these crazy markets. Keep your risk in check. Right? Keep it in check. Don't go nuts. These kinds of weeks can be very dangerous, especially with everything going on. Until the next one, thanks for watching.